As of 1:45 p.m. Eastern Time, SoFi Technologies, trading under the ticker SoFi, is currently priced at $25.98, marking an intraday increase of 1.48%. The stock has been navigating a tight range today, fluctuating between a low of $25.05 and a high of $26.09. While many retail investors see this as simply another day of fintech volatility, they are missing a critical undercurrent that is shaping SoFi's immediate future. The market's obsession with SoFi as a high-growth disruptor, a sleek alternative to traditional banking, is blinding it to the far more significant reality. SoFi is rapidly transforming into a mature, diversified financial institution, and the market hasn't yet priced in this fundamental identity shift. This isn't just about adding new members or launching another feature on the SoFi Invest platform. It's about the deep-seated change in its operational DNA, a move away from the high-risk, high-reward profile of a startup to the more measured, powerful stance of an established financial powerhouse. The prevailing expectation is that SoFi's stock will live and die by its member growth numbers and the buzz surrounding fintech innovation. This is the narrative that has propelled its incredible year-to-date run, a story fueled by a desire for the next big thing in finance. Investors flock to platforms like Robinhood and engage in SoFi investing with the belief that they are buying into a pure-play technology company that just happens to deal with money. But the reality is far more complex and, frankly, far more bullish for the long-term holder. The company's recent earnings reports reveal a startling acceleration in its banking and financial services segments, which are beginning to form the bedrock of its revenue model. While personal and student loans remain a core component, the growth in deposits, the success of SoFi Money, and the cross-selling of products like insurance and investment help through a single, seamless digital interface are creating a sticky ecosystem that traditional banks envy and fintech rivals struggle to replicate. The market sees a speedboat, but the reality is that SoFi is building an aircraft carrier. This subtle but profound transformation is evident in the stock's recent behavior. Despite the broader market chop and sector-specific headwinds, SoFi has shown remarkable resilience, consolidating near its 52-week high. Trading volume today is robust, clocking in at over 60 million shares, comfortably above its recent average. This isn't the frantic speculative volume we saw in its early days. Instead, a closer look at institutional activity reveals a significant shift. While some hedge funds have trimmed positions, major players like Vanguard and BlackRock have maintained or increased their stakes. This is patient money, recognizing that the SoFi of tomorrow is not the SoFi of yesterday. They aren't betting on a meme stock. They are making a calculated investment in a company that is successfully navigating the treacherous path from disruptor to incumbent. This is a level of sophisticated analysis that often eludes the average self-investing enthusiast who might be comparing SoFi to a flash-in-the-pan crypto platform on the Robinhood app, rather than a future competitor to the likes of Fidelity or even Schwab Intelligent Portfolios. The transition to a bank holding company was not just a regulatory hurdle, it was a declaration of intent, a signal that SoFi is playing a much bigger game. Fundamentally, what SoFi Technologies does is offer a suite of financial products and services through a single digital platform, targeting a younger, digitally native demographic. It started with student loan refinancing and has since expanded aggressively into personal loans, mortgages, online investing through SoFi Invest, credit cards, and banking services via SoFi Bank. Its business model is built on the concept of a financial services productivity loop, where it acquires a customer for one product and then leverages its integrated platform to cross-sell additional services at a much lower acquisition cost. This is the key differentiator. While a customer might have a brokerage account with Fidelity, a checking account elsewhere, and a loan from another provider, SoFi aims to be the all-in-one solution. This model is now bearing significant fruit. Recent quarterly reports have showcased not just impressive top-line revenue growth, which exceeded 40% year-over-year, but a crucial move toward GAAP profitability, a milestone many of its fintech peers are still chasing. This isn't a company burning cash for growth at any cost. It is demonstrating a clear path to sustainable earnings, driven by a powerful combination of interest income from its lending and banking operations and non-interest income from its technology platform and financial services fees. Looking toward the future, the outlook is bifurcated, defined by immense opportunity and significant tangible risks. The primary catalyst is the continued, successful execution of its integrated business model. As SoFi deepens its relationship
membership with its growing member base, now exceeding 11 million. The potential for increased revenue per member is substantial. The expansion of its financial services offerings, potentially into areas like more sophisticated wealth management tools to compete with established players like Fidelity Wealth Management and Interactive Brokers, represents a massive addressable market. Furthermore, its technology platform, Galileo, which provides infrastructure services to other fintech companies, remains a hidden gem within the company, offering a diversified, high-margin revenue stream that is often overlooked in the primary narrative. The expectation is that SoFi must relentlessly innovate on the consumer-facing front, but the reality is that its back-end technology could become just as valuable, if not more so. A crucial question for the future is how well it can maintain its growth trajectory in a potentially slowing economy. Tell me, what is your biggest concern for the fintech sector heading into the next year? Comment below with your thoughts. However, the path forward is not without its perils. The biggest risk lies in the macroeconomic environment. As a lender, SoFi is inherently exposed to credit risk. A significant economic downturn could lead to an increase in loan defaults, impacting its profitability and forcing it to tighten its lending standards, which could in turn slow its growth. Competition also remains fierce. While SoFi has built a strong brand, it operates in a crowded space, with traditional banks rapidly improving their digital offerings and a host of nimble fintech startups, from those on SoFi's own Galileo platform to direct competitors, all vying for the same customer base. Regulatory scrutiny is another persistent threat. As SoFi grows and more closely resembles a traditional bank, it will inevitably face a heavier regulatory burden, which could increase compliance costs and limit its operational flexibility. The market expects a smooth upward trajectory, but the reality is that SoFi will have to navigate these challenges with precision to maintain its premium valuation. In conclusion, the narrative surrounding SoFi Technologies is ripe for a re-evaluation. The prevailing expectation of a high-beta, growth-at-all-costs fintech disruptor is becoming increasingly outdated. The underlying reality is a company in the midst of a strategic evolution, building a diversified and resilient financial services ecosystem with a clear path to long-term, sustainable profitability. The live intraday price action, showing steady accumulation and resilience, reflects a dawning awareness of this shift among more sophisticated investors. While the risks of a challenging macroeconomic climate and intense competition are real and should not be underestimated, the fundamental strength of SoFi's integrated business model and its successful transition into a legitimate banking institution present a compelling long-term thesis. The tension between the market's perception and the company's operational reality remains wide, and for investors who can see beyond the hype, therein lies the opportunity. This is no longer just a fintech story. It is the story of a new kind of financial institution being born.